ever get that feeling? Like you're drowning in financial advice. One person's shouting about the next big stock, another's talking bonds, and you're just sitting there thinking, isn't there a simpler way, a straightforward path to, well, building some wealth without a finance degree?
Oh, absolutely. It's a common feeling. And that's exactly why we're digging into the simple path to wealth today. You asked us to look into it, not just the basics, but the arguments around it, too.
Exactly. We wanted to see if it holds up, so we're not just reading the book summary.
Right. We've gathered quite a bit. There's a really interesting Reddit discussion dissecting counter-arguments. Plus, we listened to a recent Bigger Pockets podcast with the author J.L. Collins talking about the updated book.
Okay.
And we've got summaries from the CFO Club and Mint, hitting the core ideas, and a broader overview from Bookie. So the plan is to kind of weave all that together for you.
Perfect. So, the mission today, love to cut through the noise. Let's really unpack the simple path to wealth. What are its core ideas? Where do people push back? And crucially, how can you, our listener, figure out if it actually fits your life, your goals, your comfort level with risk?
Yeah, actionable insights, not just theory.
Okay, so where do we start? What's the absolute foundation of this thing?
Well, the first big pillar, and you see this in the Mint and Bookie summaries, is living below your means, spending less than you earn.
Okay, sounds simple enough. Maybe too simple.
Well, it's simple to say, maybe harder to do consistently. But the key here, and Mint touches on this, isn't about feeling deprived. It's about being intentional. Making conscious choices. It's about creating that gap between income and spending.
Yeah.
That difference is the fuel for everything else.
Right, the fuel for the next step, which is
investing that difference.
Yeah.
And specifically, as J.L. Collins hammers home on Bigger Pockets and Mint and Bookie agree, it's about putting it into low-cost index funds.
Okay, index funds. For someone maybe new to this, what does that actually mean in practice? Like, what are we buying?
Good question. Think broad. You're essentially buying a tiny piece of the entire market, or a huge chunk of it. The classic example Collins uses is VTSAX. That's Vanguard's Total Stock Market Index Fund.
Ah, VTSAX. You hear that one a lot.
You do, and for good reason in this context. You get instant diversification, thousands of companies in one go, and, crucially, the costs are super low. That expense ratio, it seems tiny, but as Mint points out, over decades, low fees plus compounding. That's where the real magic happens for your returns. More money stays working for you.
So you own a bit of everything, it doesn't cost much, and you just let it grow. That sounds appealingly simple. Collins actually uses this for his own daughter, right? He mentioned that on the podcast.
He did. It underscores his belief in it. Okay, so pillar 1, spend less. Pillar 2, invest the difference in low-cost index funds. What's number 3?
Debt, or rather, avoiding it. Mint and Bookie both flag this one. The idea is to keep your money working for you in investments, not going out as interest payments.
Exactly. Free up those resources. But this is where things get interesting, especially when you look at the Reddit discussion we mentioned.
Ah, yes. The counterarguments start here.
They do, because while everyone kind of agrees that, racking up credit card debt on gadgets is bad news.
Right, obviously.
The idea that all debt is bad, that gets pushed back. Users like So the Movie Can Happen and Statistical Man, they bring up mortgages. Historically, buying a home, often with a mortgage, has been a major wealth builder for the middle class, hasn't it?
That's a really good point. It feels like a conflict there. Live debt-free, but also maybe buy a house.
Precisely. And one user, Cazador Holoradilla, shared a pretty tough story. They followed strict debt avoidance advice, delayed buying a house, waited for that big down payment.
And missed the boat.
Yeah, basically. Prices went up. They ended up buying later, got a, quote, worse house with a bigger mortgage than if they'd bought earlier. It really shows the potential downside of a super rigid rule about debt.
So it's complicated. Does Collins acknowledge that? What about real estate, in his view?
He does, to an extent. In that Bigger Pockets chat, he mentioned that owning a home outright with no mortgage could potentially act like a bond in your portfolio, something stable. So it's not anti-real estate itself, but more anti-leverage, especially during that main wealth building phase.
Okay, so the focus is on avoiding the debt part, less the asset itself.
Right, and the Redditors kind of ran with that. So the Movie Can Happen, Statistical Man, again, they talk about good debt, like a low-interest mortgage on a house that might go up in value, or even using credit cards for rewards. And this is if you pay it off religiously every month.
Treating it like a debit card, basically.
Exactly. No interest charges. It's a contrast to someone like, say, Dave Ramsey, who's famously very anti-debt across the board. That came up in the Reddit thread, too. So good debt isn't about morality. It's about leverage that might actually help your net worth.
Okay, so maybe a mortgage isn't always the enemy. Interesting nuance. What about other counter-arguments? Anything else bubble up in the discussions?
Yeah, another one was geographic focus. The simple path often points to U.S. funds, like VTSAX. But some Redditors, like Francis, questioned if that's enough. Shouldn't you deliberately add international funds, like VTIX or maybe VT, which includes global stock?
No. The U.S. versus the world debate. What's the thinking there?
Well, the bookie summary offers a kind of pragmatic take. It suggests that U.S. companies are already so global, think Apple, Coke, whoever, that investing in a U.S. index like VTSAX gives you a lot of indirect international exposure anyway.
Because those companies operate everywhere.
Right. So while some purists want specific international allocation, the simple path often leans towards, well, simplicity. Keep it simple, keep costs low. Maybe VTSAX is enough for many.
Okay. Simple, but maybe not perfectly diversified for everyone's taste. What about individual differences? Risk tolerance came up.
Absolutely. A Reddit user nailed it, saying the simple path doesn't account for your personal risk tolerance or desired exposure level. And that's fair. A 100% stock portfolio, which is often associated with the early phase of this path, isn't going to feel comfortable for everyone.
Yeah, I can see that. Sleeping well at night is important too.
Totally. And the bookie summary actually touches on this with asset allocation stages. Like in the wealth accumulation phase, maybe you're heavy on stocks, say 75% for growth. But as you get closer to needing the money in the wealth preservation stage, you shift more towards bonds, maybe 20% or more, to smooth out the ride.
That makes sense. Dialing down the risk over time.
And Collins himself on Bigger Pockets clarified this. He said that 100% stocks recommendation, that's mostly for when you're building wealth. In retirement, he definitely sees a role for bonds to reduce volatility.
Okay, good clarification. Now, another big fear, especially lately, market highs. The Bigger Pockets host even mentioned it, investing when price-to-earnings ratios seem really stretched. It feels risky, right?
It does. It's a perennial concern. Collins addressed it directly. He talked about the Shiller PE ratio, which looks at long-term earnings, and pointed out it's been flashing expensive for ages, like through much of the last big bull run. His take, PE ratios alone are actually pretty bad at predicting where the market's going in the short term.
So don't try to time the market based on PE ratios.
Pretty much. He stresses the long-term history. The market's gone up significantly over decades, averaging, 10, 11% a year historically, despite all sorts of PE ratios and volatility along the way. Trying to time it, in his view, is usually a losing game. Stick to the plan.
Stay the course. That sounds like a core message.
It really is. And his own story backs that up. He talked on the podcast about how he used to try and pick stocks, which he admitted was kind of exciting.
The thrill of the chase.
Right. But ultimately, he found that just consistently buying and holding the broad market index did better than his attempts to outsmart it. That shift to indexing is central to his philosophy. For most people, matching the market reliably beats trying and often failing to beat it.
Okay. Given that simplicity, what about financial advisors? Do you even need one if you're just buying VTSX? That came up on Reddit too, didn't it?
Yeah, user Succotash 927 kind of suggested that the strategy's simplicity makes advisors seem less necessary. And the bookie summary leans that way too. Maybe avoid costly advisors if your plan is this straightforward.
Makes sense. If the path is simple.
Right. Why pay someone a lot to tell you to do the simple thing? But advisors can still be valuable for complex stuff, estate planning, intricate tax situations, or just for people who want that professional handholding.
Yeah.
But for just executing the basic simple path, maybe not essential.
Got it. Okay, one more from the Reddit fringes. What about total collapse scenarios, black swans? One user mentioned diversifying into gold or land in case the whole system goes kaput.
Yes, the end of the world as we know it's hedge. User N7DJN8939SWK3 brought that up. Another user, Original Competitive, kind of framed it as a more deeply conservative or risk-averse view.
So not really part of the core simple path strategy?
Not typically, no. The simple path operates on the assumption that the broad market, over the long haul, will continue to function and grow. Hedging against those really extreme, low-probability events with tangible assets is a different kind of strategy, generally outside the scope of what Collins advocates.
Okay. So fascinating range of perspectives there. Now, you mentioned J.L. Collins updated the book. What did he say on the Bigger Pockets interview about how his thinking might have evolved or what's new?
Yeah, a few key things. He really doubled down on clarifying the 100% stocks idea. It's for accumulation. For retirement, bonds are important for managing volatility, providing that dry powder to use if the market tanks, or just to live on.
So not 100% stocks forever.
Definitely not prescribed for everyone in retirement. Although, interestingly, he shared his personal potential plan because he's financially secure. He might actually go back to 100% stocks, even in retirement, if there was a huge market crash, aiming for long-term growth for his heirs and charity. But that's specific to his situation.
Wow, okay, that's a nuance.
Yeah.
Just flexibility depending on circumstances.
Exactly. He also talked about how a paid-off house or even a stable pension could functionally serve a similar role to bonds providing stability. And he just generally reaffirmed his strong belief in broad index funds being the best bet for most people. His own journey from stock picker to indexer is a big part of his story.
And the updated book itself. Anything specific you mentioned?
Yeah, the 2025 edition. He said it has a big new FAQ section tackling common questions, which sounds really useful, and also a case study about someone going through serious financial hardship, making it maybe more relatable and practical.
Sounds like valuable additions. Okay, so let's try and wrap this all up. After digging through Collins, the Redditors, the summaries, what are the main takeaways for you, the listener?
Okay, first off, the core principles work. Spend less than you earn, invest that difference consistently in low-cost, broad market index funds, and avoid high-interest debt. That's a powerful, simple, historically proven framework. Don't underestimate its
The
effectiveness.
simplicity is the strength, in a way.
It really is. Makes it accessible.
Yeah.
But, and this is takeaway number 2, it's not dogma. As the Reddit chat showed, you absolutely need to filter it through your own life. Your risk tolerance, your goals, your timeline.
Right.
Maybe carefully consider real estate makes sense for you. Maybe certain low-interest debt is strategic. The path is simple, but the application needs your personal touch.
It's a template, not a rigid blueprint.
Exactly. And the final key takeaway. You got to play the long game. Markets go up, markets go down. Volatility is normal. Trying to time it is usually a mistake. Stay invested, keep learning, and adjust your plan thoughtfully as your life changes. That's crucial.
So, to recap, simple path core, solid foundation, nuances around debt, real estate, risk, important personal considerations. Long-term view is essential. It's a framework, but you got to make it your own.
Well put. Which leads us to, maybe a final thought for you listening. Reflecting on all this, what's one thing in your current financial approach you might want to revisit? Not a total overhaul, maybe just a tweak. Is it how you think about debt? Your asset mix? Does real estate fit differently now? Just something to ensure your path, however simple or complex, truly aligns with your destination.
That's a great question to ponder. And if you want to go deeper, definitely check out J.L. Collins' book, especially that updated 2025 version. Keep exploring index investing. Maybe look into those alternative ideas we touched on. And please, share your thoughts or questions with us. We'd love to hear how this deep dive resonated with you. Thanks for joining us on this exploration of the simple path to wealth.